What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Dollar General. A lot of you guys have been asking questions about this company that has dropped a little bit over 50%, and it's just been selling off pretty aggressively. It's come down to $130 per share. So I'm going to do a complete analysis on this company, break down exactly what went wrong, what is going on, and of course talk a little bit about the technical analysis and where the next support levels might be. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join, and the Labor Day sale is going on right now. It does expire Monday night if you want to take advantage of that as well, and that is going to also be the link down below. 50 to 60% off. Fundamental analysis, technical analysis, option scores, the bundle, everything is going to be significantly discounted, and the coupon code is LABOR4 until, again, Monday night is when this expires. So Dollar General is the company that we're analyzing today. Pretty significant sell-off here. So you can see that it's trading down to $130 up, and it's down from $260. It's been cut in half, pretty much down about 50%. But this right here is some of the reasons as to why the shares are down. So they're cutting guidance. They've got a lot of inventory, and of course the sales declined on a year-over-year basis. So Dollar General shares sink on second annual forecast cut, disappointing investors. So the stock obviously trading as low as $120 as a 3.5-year low, making it one of the worst performers on the S&P 500 indexes so far. And the analyst from Citi basically says, and I quote, "We thought there was a risk that DG would need to invest more in stores than management initially as expected and reduce guidance as a result, but this is a much bigger cut than we and the market were expecting." So they basically cut guidance because I think they're selling a lot of their products at a huge significant discount because of the bloated inventories that they have. So CFO basically mentioned, and I quote, "Our revised guide is really a function of the slower transactions that we're seeing and higher expected shrink." Now, shrink is basically referred to as the loss or theft of goods, right? Or even damaged goods. So that's what's referred to as shrink. And Dollar General right now is expecting a higher than expected shrink. And part of me tells me that it's only because they've got so much inventory that they are basically just giving it away, right? They're basically, because a lot of companies during the pandemic bought so many goods and services, basically overhired and bought so many products because at the time, all people were doing were basically at home with all the fiscal stimulus that was coming in, all the money that they were making, income rates skyrocketed, savings rates skyrocketed, and people were spending a lot of money, right? So we've gone through this with Target, we've gone through this with Walmart, we've gone through this with now Dollar General, where a lot of these companies have significant amounts of inventory, so they're double and triple ordered, and now they're kind of have this backlog that they need to get rid of first before they can start selling through some of the newer products and newer items. So discount retailer plans to clear excess non-consumable inventory and ramp up labor investments ahead of the crucial holiday season. So again, they need to get rid of that excess non-consumable inventory, and Dollar General's aggressive guidance cut should help establish a floor on the stock, but a deeper look suggests a strategic pivot may not be enough, is what Wells Fargo also mentioned. So net sales did increase about 3.9% to just under $10 billion. Same store sales declined about 0.1%. Operating profit decreased 24%. And diluted earnings per share were down 28.5%. And year-to-date cash flow from operations of $726 million. But they do have a pretty significant CapEx, and that's why the free cash flows are negative for the company right now. They've also got very little cash, so only $353 million worth of cash on the balance sheet, with merchandise inventory, as you can see, $7.5 billion. That's up from 6.7 from same time last year, and also on actually this is up from quarter-over-quarter basis, and also up on a year-over-year basis from 6.9 billion. So 7.5 billion is what they have, and total current assets of $8.4 billion, but over 90% of that is made up from merchandise inventory. Goodwill is 4.3 billion, so that's also a pretty sizable goodwill, and total assets at just over $30.3 billion, with their long-term obligations are going to be sitting at just under $7.3 billion. So they do have, pretty sizable amounts of debt with a little to no cash and a lot of inventory. So the balance sheet's not the greatest. This right here is going to be their revenue and gross profit profile. So you'll notice that they have consistently been able to grow the revenues. That's one thing that Dollar General is able to do well, is grow, right? Grow, because $17.5 billion has more than doubled in the last 9 years to over $37.8 billion, and gross profits gone from $5.4 billion to over $11.8 billion as well. So very nice, consistent growth. Operating income also moving in the right direction from $1.7 billion to over $3.3 billion for the company. Now, when it comes to net income, it's gone from about $1 billion to over $2.4 billion. So that's about a 140% increase in the last 9 years. Very strong, consistent growth. So they're still profitable. They're still able to grow some numbers here. But of course, they are now starting to struggle with the guidance cut because of the over inventory, excess levels of inventory. And they've also got consistent share buyback. So 323 million shares brought down to 222 million. That's a 4% share buyback every single year. That's very, very good. This right here is going to be their margins. So 31% gross profit margins, net margins at 5.5%. Come on, it's Dollar General, so we can't expect higher margins. We got return on common equity, capital, and assets, pretty decent. Common equity return is pretty good at 34%. Other metrics are okay. Not the best, but not the worst either. And net income per employee has come down from $14,400 5-year average to just a little bit under $13,000. So definitely a little bit of a less efficient business than compared to its 5-year averages. Free cash flow was positive up until the trailing 12 months, negative $501 million. And that's partly because of the higher CapEx. So CapEx is at now $1.6 billion on a trailing 12-month basis. So we're not going to be able to use a free cash flow model on Dollar General because free cash flow is negative. Now, when it comes to balance sheet, again, sitting on about $18 billion worth of debt with only $353 million of cash. So total debt net debt over 17.6 billion. So not that great. And we got current ratio 1.39, but as I pointed out earlier, over 90% of their assets are in merchandise inventory. So the quick ratio is 0.08. Really, really poor, right? So we're looking at very bad short-term liquidity for Dollar General. So they won't even be able to pay their bills if their current liabilities are something to do with accounts payable. So for example, accounts payable, 3.6 billion. And that's under current liabilities. So they have basically $3.6 billion worth of bills coming in due in less than 1 year, and they don't even have the cash to pay for it, right? So they're going to take on more debt, or they're going to raise more equity by selling shares. One of those two things has to happen. And I think it's going to be the former. They're going to take on more debt, long-term debt, to basically pay accounts payable, or use their credit line to pay those accounts payable, because they're not known for issuing a lot of shares, because they've been consistently buying back shares. As you can see, they have a pretty solid share buyback program. So I'm not expecting them to issue a lot of shares and dilute shareholders, but instead take on debt to pay those accounts payable. So that's why the balance sheet's really, really bad. This right here is going to be the valuation. So because the stock price is down 50%, obviously it's trading at a very cheap valuation. I wouldn't consider this as like super undervalued, like massively undervalued, but yes, it is cheap in my book. 13 to 16 times earnings multiple. We got price to sales at under 1, price to cash flow at 12 to 16 times at the moment, and the earnings are expected to once again reaccelerate after the decline from this year at around 23% decline this year, and then expected to increase from about $9 all the way to almost $28 per share for Dollar General. So if we go over to some of the numbers here, the earnings are expected to grow anywhere between 14 to 16%. Free cash flow, we can't calculate, as I said earlier, because we've got negative free cash flow, and 4% share buyback every single year. So if I go with about 12%, right, that's a reasonable conservative expectation of 12% growth rate for the company's net income over the next 5 years, a price to earnings multiple of about 12, right, keeping that PEG ratio close to 1, and right now it's trading at 13, so there's not much of a compression left, and we're looking at a 12% discount rate. Might even be lower because the company does pay out a dividend, so we're looking at a 1.8% dividend yield. So if I go with 11% discount rate, 10% margin of safety, minus 4% in share dilution, because that's what they have done over the last 10 years, and about 100% weighting to earnings per share, because again, they don't have a free cash flow, so we can't use that. So 0% weighted average for free cash flow. We get down to a fair value of close to $127. And right now it's trading at about $130. $130.27. So only 1.7% downside needed in order for Dollar General to be trading at its fair value. And the beautiful thing is that it's also trading at a very nice support. In fact, my support is exactly at 127, in line with this previous support during the pandemic. So this right here, very nice technical support for Dollar General at 127. And that's exactly where the fair value, holy, It's only off by 40 cents. The fair value and the technical support is only off by 40 cents. It's crazy. It doesn't happen that often, right? That your technical support and your fair value ends up at the same price. But that being said, I do want to point out some very, very important concerns. Number one, the balance sheet, right? Balance sheet is a huge concern for me. If this company had negative net debt, they have more cash than debt on the balance sheet, there's no risk of bankruptcy, I would be all over it, because technical support, we've got the intrinsic value, everything's sitting right there, 127, low valuation, down 50% from its all-time highs, consistently growing revenues and earnings. You get the idea. But the balance sheet is a big concern, that they've got very, very short-term liquidity is a problem, 0.08 quick ratio, and we've got, of course, a lot more debt than cash on the balance sheet. So that's a big concern, and of course, growth concerns are also going to be there. I don't think that Dollar General is going to although struggle in a recessionary environment, because they have such cheap products that they sell that most people are going to be looking to save during a recessionary environment, and Dollar General is usually the place where they go to for basically buying their necessities, right? Because it's a discount store. So they actually tend to do better during recessionary times. It's a defensive stock at the end of the day, but balance sheet's an issue, right? Can they survive, right? Can they survive long term? Or if this is just going to be a company that eventually goes under, right? That's a big concern. But like I said, 127 is going to be that support, very, very oversold. We did get a little bit of a breakdown here, then continued sell-off, accelerated further below 150, and now we're trading at 130. So let me know in the comment section down below, what do you think about this stock? Don't forget, Labor 4 is the coupon code for all the courses, and of course the first week of the month is the best time to join our Discord. Happy to have you guys on board. As always, happy investing, and I'll see you all in the next video.